Good morning, dear students. We will move to our next module, second module, that is financial statement analysis. So, financial statement analysis is also called as financial analysis or analysis and interpretation of the financial statement. And financial statement refers to the process of determining the financial strength and weakness of the firm by establishing a relationship between the items in balance sheet and profit and loss account. So financial statement means that includes two items, the balance sheet and P&L account. So we are analyzing these two statements and we are getting some kind of interpretations or result. Then now we will see what are the objectives and importance of financial statement analysis. The first one is to assess the earning capacity or the profitability of the firm. Then to analyze the operational efficiency and managerial efficiency of the firm. Then third one is to assess the short-term as well as long-term solvency position. Solvency position means what? The ability of a firm to meet its long-term obligations. And short-term means the liquidity position of the firm. The next one is to identify the reasons for changing the profitability and financial position of the firm. Then to make inter-firm comparison means we are comparing the balance sheet or P&L account of two companies. Then to forecast the future prospects of the firm. Then to assess the progress of the firm over a period of time. Then it helps in decision making and it helps to, or it is a guide in determining the dividend action, and finally it provides an important information for granting credit. Then who are the parties interested in financial analysis or financial statement analysis? Investors are there, management, creditors or suppliers, bankers and financial institutions, employees, government, trade association, stock exchange, economists and researchers, and taxation authority. This financial statement analysis can be classified into different ways. Then on the basis of material used, there is two kinds of classification is there, that is external analysis and internal analysis. External analysis means this is done by the outsiders who do not have access to the detailed internal accounting records of the business of firm, and that is mainly done by the potential creditors, investors, creditors, government agencies, credit agencies, then public, etc. Then internal analysis means it is analysis conducted by the person who have access to the internal accounting records of the business of the firm. Okay. Then on the basis of modus of operandi, that means the materials used, on the method of operations followed in the analysis, that is horizontal analysis and vertical analysis. Horizontal analysis refers to the comparison of financial data of a company. So horizontal means that is moving like this. So we are comparing the financial statement of the company of 2008 with 2009. So we are comparing the two years of items in the 2 years. So this is what horizontal analysis, and this type of analysis is also known as dynamic analysis. Okay. The next one is vertical analysis. Vertical analysis refers to the study of the relationship of the various items in the financial statement of one accounting period. So vertical means this is moving like this. So in the year of 2008, we are trying to study all the items in 2008. All the items means all the items that is mentioned in the financial statement, either in the balance sheet or P&L account of a company. And this type of vertical analysis is also known as static analysis, and here common size financial statement and financial ratios are the two tools employed in the vertical analysis. And in the case of comparative analysis, the comparative statement and trend analysis are being used in the horizontal analysis. Then on the basis of entities involved, we can classify the financial statement analysis into cross-sectional or inter-firm analysis and intra-firm analysis. Inter-firm analysis means the comparison of financial data of a firm with the other firm, like competitors or industry averages, etc. Then intra-firm means the analysis that is being conducted by a company over a period of time. Inter means we are comparing the financial statement of two companies. Intra means the analysis that is taking place within the company. Then on the basis of horizon or objective of analysis, it is short-term analysis and long-term analysis. Short-term analysis means mainly we done to measure the liquidity position of the firm, and long-term analysis is mainly done to analyze the long-term obligations or the solvency position of the company. Then different methods or devices of financial analysis. Comparative statement, that means comparative balance sheet as well as income statement, both will come. Then trend analysis, common size statement, here also compare common size balance sheet and a common size income statement. Then we have fund flow analysis, cash flow analysis, ratio analysis we have already seen. Then cost to volume profit analysis. And in this module we will discuss about these three items: comparative statement, trend analysis and common size statement. And we will see how we can work out all these things. First one is comparative statement. So comparative, from the word itself we can understand that we are comparing something. So in order to compare something we should have at least two items should be there, right? So one item and at the same time there will be second item will be there. So we are comparing the first item with the second item. This is what happened in the case of comparative statement analysis also. So comparative financial statement are the statement of the financial position at a different period of time. So this is very important. Different period of time. That means in the year of 2019 and in the year of 2018. We are comparing the items of the financial position of company during this 2 years. The elements of financial position are shown in a comparative form so that it gives an idea about the financial position of two or more periods. Any statement prepared in comparative form will be covered in comparative statement. So the how we can express or how we can work out this, mainly there is a format for preparing comparative balance sheet. So here we include, first one is absolute figures, the exact amount of items will be given there. Then we will see the change in absolute figures, like whether it is increase or decrease in the amount. And then we will say absolute data in terms of percentage, whether the increase or decrease happen, and that we will express in terms of percentage. Then the very important part of financial statement analysis is the interpretation. So we will do the calculation and at the same time the interpretation also very important. So how we can interpret the comparative balance sheet? Mainly three items are being, or in three levels the analysis interpretation is being done. The first one is current financial position and liquidity position of the firm. Then what is the long-term financial position of a company and how the profitability position of the company. And how we are analyzing the current financial position or the liquidity position of a company. For studying current financial position or short-term financial position of a concern, one should see the working capital in both years. And how we can get this working capital? Current asset minus current liability. So we should check what is the position of the current asset and a current liability in the company. The excess of current asset over current liability will give the working capital. The increase in working capital will mean the improvement in the current financial position of the business. An increase in current asset accompanied by the increase in current liabilities of the same amount will not show any improvement. For example, if current asset of the company is 2 lakh and the current liability of the company is also 2 lakh, does it have any positive impact to the company? No, because the current asset and current liabilities are same. There is no improvement in the working capital position. But at the same time, if current asset is 2 lakh and current liability is 1 lakh, that means the current asset, the excess of current asset is there as compared to current liability. So this shows a favorable position to the company, and this is an unfavorable situation to the company. So this is how we analyze the current financial position of a company. We need to take into consider the current asset position and current liability position, and also we can study about the liquidity position of the company also. So how we can calculate this liquidity position of the company? We have already seen in ratio analysis how we can calculate liquid asset. That means two items will be excluded from the current asset. That means current asset minus stock and prepaid expense. So when we deduct both items from the current asset, we will get the liquidity position of the company. So this is how we can analyze the current financial position of a company. So once all the calculation is being done, the second part is the interpretation. So the first thing that you need to interpret is the current financial position of the company. Then after that we need to interpret on the long-term financial position of the company or the solvency position of the company. So in order to do that, the long-term financial position of the concern can be analyzed by studying the changes in fixed asset. Okay, fixed asset here we are considering, and the long-term liabilities and the capital. So we are trying to establish a relationship between fixed asset and long-term liability. And long-term liability means liability to outsiders as well as the capital being included in the company. The proper financial policy of the concern will to be finance fixed asset by the issue of either long-term securities such as debenture, bonus, loan from financial institutions, or issue of fresh share of capital. So when we are analyzing the fixed asset part of a company, an increase in fixed asset should be compared to the increase in long-term loans and capital. So suppose if you are saying that okay, fixed asset position of the fixed asset is being increased, at the same time what we need to do, we should analyze the fixed liability part, whether it is being increased or it is being decreased. Okay, then if the increase in fixed asset is more than increase in long-term security, then part of fixed asset has been financed from the working capital. On the other hand, if the increase in long-term security is more than increase in fixed asset, then fixed asset have not only been financed from long-term sources, but a form of working capital has also been financed from the long-term sources. That means fixed asset, suppose if I want to purchase a machinery or a plant or a furniture, so from where I need to identify the money for that purchasing, I can get money from the liability part. That means from the share capital that we issued, or the bonus that we issued, or the debenture that we issued. From all these what receiving to the company will get the capital or money. So either I can finance the amount of collecting buying fixed asset from the fixed liability. So if fixed asset is more than fixed liability, that is the part which is being given here. Increase in fixed asset is more than increase in long-term security. That means a part of fixed asset, in order to purchase a fixed asset, the company utilized amount from the liability part, fixed liability part. Then suppose if fixed liability is greater than fixed asset, that means the in order to purchase fixed asset, this amount fixed asset is being financed from fixed liability, and also a part of working capital also being financed from the fixed liability. This is how we analyze the long-term financial position of a company. The next one is we should study about the profitability position of the concern. That is the next part. The study of increase or decrease in retained earnings, various resource and surplus, etc. will enable the interpreter to see whether the profitability has improved or not. So how we can calculate or analyze the profitability position of the company based on retained earnings and other various resources and surplus, like resource and surplus, etc. An increase in the balance of profit and loss account and other resources created from profit will mean an increase in the profitability of the concern. The decrease in such account may mean issue of dividend. Means if the profitability position is decreased, that means the company has issued profit by providing dividend, bonus, or there might be some kind of deterioration in the profit, etc. Then after studying all these items like current financial position, then long-term financial position, and profitability position. So these three things we need to interpret. And after that, what we need to say? We need to mention the final interpretation, like whether the financial position of the company is favorable or not. This is what we need to done in the final part, or we are like interpreting the overall financial position of the company, whether it is satisfactory or not, or it is favorable or not, etc. So now we can work out a problem like comparative balance sheet. How we can do this comparative balance sheet analysis. So this is one question is given. So in every question for comparative, in order to do a comparative balance sheet, we should have all the items will be, particulars will be given in the question, and at the same time the figures of 2 years will be given. So we are comparing items in 2 years. So this is what comparative balance sheet. Okay, so this is how a question will appear and how we can work out this. So first we need to write comparative balance sheet for the year ending. Okay, here in the question it is given 2010 and 11. So whatever be the year mentioned in the question, you can write it that for the year ending this 2010 and 11. So you should mention it is comparative balance sheet for the year ending. So this is one thing that you need to write. Then after that, the first 3 columns, right? It is same as the question. But for every question, for answering the question, you can follow a format, like you can start from asset, and then you can write current asset, fixed asset, then total asset. Then you can move to the liabilities and capital. You can start from current liability, then debenture and other capital like equity share capital, preferential capital, then the reserves part, and finally we will have the total. So this is a format that you can follow in every question. sometimes in question it is the liability part will be given at the top, or sometimes it is asset part will be given. So it is better to follow a format like you can start from asset side and you can end with the liability part. Okay, so 2010 figure you can write it as same as in the question 2011. The next two column, that is what very important, column 4 and 5. Then how we can do? Here we need to say increase or decrease. In figure we are saying whether the items in the current year is, we are comparing that with the previous year. So here the latest year is 2011. So we are comparing as compared to 2010 whether the cash is being increased or not. This is what we are studying over here. So the first item here is in 2010 the cash position is 300 and in 2011 the cash position is 400. So by comparing we are doing like the current year minus previous year. This is how we are calculating the items. So we will check 2011 minus 2010. This is how all the calculation is being done. Okay, so as compared to 2011 the cash position was, it is given in lakhs, okay, 440, and in 2010 it is 300. That means there is an increase of 140. So that you can mention like plus 140. Then how we can express this in terms of percentage? So whatever be the increase happened in the what increase that happened as compared to the previous year, that is how we will calculate the percentage. Okay, so in order to calculate percentage, just 1 second. Okay, how we can calculate? It is, what is the increase or decrease that is happened? Here it is 140. And in the denominator what we will take? The base year we will take as denominator into 100. And what does it give? It is 46.67. Okay, so whatever the change is happening, that is given in the numerator part, and the base year will be given as denominator, that is multiplied by 100 will give the percentage. Okay, then coming to next item, that is stock. In base year we will take as 2010. So as compared to 2010, coming to 2011 there is an increase of 100, right? Then how we will calculate the percentage? 100 divided by 200 into 100. That means how much? 50% is the answer. Then coming to, okay, then we can calculate the total asset. Here it is 500, here it is 740, and what is the total increase that happened in the case of current asset? Plus 240. And what is the percentage of this? It is plus 48. So this is how you need to calculate for all the items. For the, you just need to minus from the items in the latest year with the previous year, and you just need to calculate the percentage. This is only that we need to do in the case of comparative balance sheet. And here coming to fixed asset, in 2010 it was 100 and 2011 also it was 100. That means there is no change. So you can give it as blank. Means there is no increase or decrease. It remains as static. Then coming to building, it is 300 was there in the 2010, but coming to 2011 it become 270. That means a decrease of 30 is happened, like right, 30 lakh is being happened. So how we can calculate the percentage? 30 divided by 300 into 100. That means 10 percentage is the answer. That means minus 10 percentage. Okay. Then in the case of plant also, it is being decreased by 30 and the same percentage will here come. So furniture, it is increased by 40, and what is the percentage of that? It is plus 40 will be the percentage. You need to calculate, right? Then it is a total fixed asset. It was 800 in the 2010, but that is being decreased by 20. And what is the percentage of this? 2.5 is the percentage. And then you need to calculate the total of this. So you can add all these things. That means 220. And here the percentage is become 16.92. Okay, so the same thing that you need to do for the liability part also. So in bills payable, it is the liability is increased by 25 and the percentage for the same is the 50. And coming to creditors, it is being increased by 50, and what is the percentage for the same? It is 33.3. Then tax payable, it is 100, it is increased by 50, and what is the percentage for that? It is 50 percentage. Then we need to take the total of current liability, that is okay, it is 125, and what is the percentage total? It is 41.67. Then we have debenture is given, and that is being increased by 50, and what is the percentage for the same? That is also 50 percentage. So then what is the total liability? 175, right? 175, and the percentage become 43.75. 43.75. And in the same way you need to calculate for equity and also, but here equity share capital there is no change, it remains the same for both year, and preference share also it remains the same for both year. And for reserves what happened, it is increased by 45, and the percentage for the same is 22.5. And finally we need to add all these things, that means plus 220, and the percentage for the same is 16.92. So this is how we need to do the calculations. It is very simple. You just need to minus the current year with the previous year and check whether it is increased or decreased. If it is increased, you can mention it by plus side. If it is decreased, you can mention that by minus side. And then you need to calculate the percentage for that increase or decrease. This is only we need to do for the comparative balance sheet. Then next part is the interpretation. You need to interpret the result of this. Then how we can interpret? First we need to analyze the current financial position. So current financial position means you can have a look on current asset and current liability. You can compare with that. See, for example, here the current asset is being increased by 240 lakh. Okay. At the same time, what is current liability? It is increased by 125 lakh, right? So 240 increase, and here it is 140 increase is being happened. That means the current asset position or current financial position is somehow it is favorable because current asset is more than that of current liability. So we can say that okay, the current financial position of the company is favorable. Okay, then what the second thing is the long-term financial position of the company. Then long-term financial position is how we need to calculate or how we need to interpret. You just need to interpret by fixed asset and fixed liability. This is how you need to compare. So here the fixed asset is total of fixed asset okay, it is fixed asset. From this we know that it is something, it is being decreased, right? And at the same time the equity share capital or the long-term capital position, it remains as constant. But here what happened, the fixed asset position is something that is being declined. So we can say that in the long-term financial position of the company should take some care. Okay, in that way we can interpret about the long-term financial position of the company. Then what about profitability position of the company? Profitability can be compared with the help of reserves. That is how we will compare about the profitability position of the company. So here in question there is only one reserve mentioned here, that is this part is only here, there is no other surplus or nothing is given. So here it was 200 lakhs in the year of 2010, and when it comes to 2011 it is increased by 45 lakh. That means the profitability position is something that is favorable because there is an increase of 45 lakh is being happened. Then finally what we need to say, we need to comment on overall financial position of the company, that you need to comment. So by analyzing all these things, the current financial position is somehow okay, the profitability position is somehow okay. The only thing is the long-term financial position, the company should take some more care. So this is how you can interpret the comparative financial statement.